What is going on YouTube? Welcome back to another video. In today's video, we're going to be talking about the differences between investment banking careers and private equity careers. And the reason for this is because typically investment banking analysts spend a few years in banking and then they move into private equity. So hopefully with the information in this video, you'll be able to make a more informed decision or maybe even save some time if you're interested in going into investment banking or private equity. The topics we're going to cover in this video include the focus of the two areas, the investment time horizon, the capital structure, risk and return profiles, role in operations, capital commitment, exit strategies, and more. Big shout out to Financial Edge for sponsoring this video. If you want to get a 25% discount off their online courses and the investment banker course in particular, hit the link in the video description below. With that, let's get into the video. All right, first things first, the focus of investment banking versus the focus of private equity. So investment banking primarily focuses on advising companies, governments, basically advising their clients on how to raise money or merge or acquire other companies, right? So it's advisory services, whereas private equity, it's not focused on advice, it's more focused on gaining ownership. So they're actively looking to own pieces of companies. And the reason for that is in private equity, you're interested in owning a piece of a company or owning a company, improving it, and then either selling it to a bigger company for a profit or taking it public through an IPO and then reaping the rewards of that growth. Whereas in investment banking, the focus is on advising clients and then charging them a fee for that advice. So you're getting paid for giving advice in investment banking, and in private equity, you're getting paid for ownership. You're owning equity, private equity, so equity, stock or ownership of a private company. You own that, and as it grows or improves, you benefit from that growth. There are things called private equity fund of funds, and that's for another video, but that's basically a fund, a pool of investments that invest in different private equity opportunities. I could do a video on that next time. Let me know in the comments if that's of interest to you. Next, we've got investment time horizon. So investment banking deals tend to be shorter term compared to private equity deals. And the reason for that is when you're working on an investment banking deal, it might span anywhere from 3 months to 6 months to a year or 2 years, maybe 3 years at most, right? And once that deal is done, you move on to the next one, and you've got lots of different clients and you're moving from deal to deal to deal. And from each deal, you take a fee, like the investment bank takes a fee, right? So 3 months to 6 months to a year or two. In private equity, you're taking an ownership stake in a private company and you're going to hold that for 5, 10, sometimes even 15 years. So it's a much longer term business. The time horizon is a lot longer in private equity. So if you're going into investment banking, it's important to know you're going to be working on deals that can span up to 2 years, sometimes less, mostly less. And if you're going into private equity, the deals that you're going to be involved in are very, very long-term focused. So you're going to be locked into a company or, you know, lots of different companies for at least 5 or 10 years. And the reason for that is because it will take 5 or 10 years to, you know, improve the company that you have been investing in or taken ownership of so that you can see dramatic changes. And then 5 or 10 years later, they might get acquired by a bigger company, and then they get acquired, and then you reap the benefits or the rewards in terms of, you know, your returns for holding on that long and being able to sell your equity, your shares on the private market for 5x or 10x the amount that you initially paid to acquire them. All right, next we got the capital structure differences between the two. So in investment banking, you are typically dealing with financing in the public markets. So what this means is typically when there is an initial public offering or debt financing or equity financing in investment banking, it's typically done through the public markets. The public markets are accessible to retail investors, institutional investors, etc. However, in private equity, it's typically done through the private markets, so it's less accessible. Also in private equity, most of the transactions are done through leveraged buyouts. What's a leveraged buyout? Long story short, a leveraged buyout is basically leverage, so you're taking on lots of debt, so you're borrowing money, and you're using that leverage or that debt to buy or acquire a company. Now, the collateral, the thing that's going to be given up if you can't afford to pay back the debt, is the company that is being acquired. So a leveraged buyout is where you are taking on lots of debt and using the acquired company as collateral. So private equity uses leveraged buyouts for the most part, and investment banking doesn't. So when you think of private equity, think of leveraged buyouts and private markets, whereas when you think of investment banking, think of public markets for debt financing, equity financing, initial public offerings. Whether you're interested in going into investment banking or private equity, listen up, because today's video sponsor has something in store for you. They are Financial Edge Training, and they train the analysts and associates at the top 4 global investment banks. Now, specifically, I want to mention their investment banker course. So it's an online program where you learn everything you need to know about investment banking and the role of an investment banker specifically. If you are interested in the investment banker, then you can expect to learn everything you need to know, from raising capital to mergers and acquisitions, regardless of whether you're an intern, an analyst, or an associate, or if you have no prior experience in this industry. It's for everyone. Now, if you don't want to enroll on that course, they've got tons of resources, lots of free resources as well, that can help you learn more about portfolio management, investment banking, trading, sales, hedge funds, asset management, so on and so forth. So do check out their website. I've been partnering with Financial Edge for the best part of 4 years now, and I recommend their courses to a lot of individuals because they really do know what they're talking about. After all, they train the analysts and associates at the top 4 global investment banks as rated by the Financial Times. So you're in safe hands. And don't forget, if you want a massive 25% off, hit the first link in the video description down below and use the code AFSAL25 at checkout. Now let's get back to the video. Risk and return. So in investment banking, you're typically making fees based on the number of deals you are working on. So the more transactions that you do, the more fees you generate, right? Pretty straightforward. In private equity, the returns that you generate don't come from advisory fees like in investment banking, but they come from a number of different factors, some of which could be the cash flow generation of the company that you have invested in, capital appreciation, and a potential exit, for example. There is a higher potential return in private equity than in investment banking, but that comes because you are taking on a higher risk. So in private equity, you're holding on for longer time horizons, so 5, 10 plus years. Because you're taking that greater risk compared to investment banking, you are gonna be, you should expect a potentially higher return. It doesn't always play out that way, but that's generally the key difference between the risk and return profiles in private equity and investment banking. All right, so here's a good one: the role in operations. So in investment banking, you're just advising companies on how to raise capital or how to acquire a firm, whatever, right? You're not actually going into those companies and running the day-to-day strategic decisions, taking care of things going on within the organization. That's what you do in private equity. So in private equity, you might acquire a company or take a controlling stake, and then you might actually put 1 or 2 of your partners or your employees, senior employees, as board members into these organizations, so that in private equity, basically, you are actually taking an operational role within these companies that you acquire. So you're taking a role in strategic decision making, governance, operations, whatever it might be. The aim is to help this company operate more efficiently and more successfully so that you can help it grow, and then you can get a good return in future. All right, capital commitment. So in investment banking, firms don't commit any capital. They don't put any money, like Goldman Sachs investment banking division isn't going to put any money into the deals that it works on, right? There'll be a conflict of interest. Instead, they just advise on the deals. In private equity, the private equity firms are actually going to commit capital. So they're going to put money into the deals that they are working on, so that, you know, they have some skin in the game, and also it's of interest to them because if the investment works out well, that money increases or grows for them. So in private equity, you are committing capital, and you're committing anywhere from tens of millions of pounds to hundreds of millions of pounds, sometimes even billions of dollars or pounds. So you are committing capital in private equity, and in investment banking, you're not committing capital. All right, it's important to flag or mention there's lots of different types of private equity firms. So some firms will invest their own capital, and that's that. But a lot of private equity firms will raise rounds. So they will say, you know, we're raising £100 million or dollars private equity fund to invest in technology private companies, for example. So they will reach out to their clients, lots of different individuals or companies or firms, and try and get 5 or 10 or 50 or 20 mil checks from these individuals. So they get lots of different clients investing that money, and then me, for example, as the private equity firm, I'm going to have $100 million or $1 billion to invest into technology focused companies, private technology focused companies. So I've raised a fund, I've raised money, leveraging my clients. Now I'm going to invest that money into these different private equity opportunities. I could do a video going into more detail on private equity specifically. I'll probably write a career guide similar to my asset management and investment banking career guides that I've done already. That will be in due course, but let me know if that's something of interest to you in the comments down below. Also, if you're interested in the investment banking or asset management career guides, one's 99 pages, one's 70 pages, it's linked in the video description down below, so check that out as well. Also, there's this thing called limited partner commitments in private equity and general partner commitments, but that is a topic for a whole different video. That will open up a whole different can of worms. So we'll touch on that next time. Exit strategies. So in investment banking, there isn't really, like, you're not really playing for an exit, because whether you advise a company on an initial public offering or you advise them on a merger or an acquisition, you're still getting your fee. In private equity, on the other hand, the exit strategy is more important, because the private equity companies will be thinking, is it more profitable for us to exit through an initial public offering? Or is it more profitable to make sure this company gets acquired by a bigger player in the same market, so on and so forth. So there's different exit opportunities that are more relevant to private equity firms, whereas in investment banking, it's more, you're making your money from advising, you're getting a fee, right? So the exit strategy isn't as important compared to that in private equity. And those were some of the key differences between investment banking and private equity careers. If you made it to the end of the video, give it a thumbs up and leave any comments down below to let me know which video you want to see next, and I will see you in the next one. Peace.